Hi guys. Today we will analyze Discover stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Discover has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, the long-term trend is neutral. Not much exciting going on here. Support levels are around $101 and $95. The next support levels are around $91 and $85. Resistance levels are around $112.50 and $118. The next resistance levels are around $124 and $128. In the last month the stock has been trading between $100 and $128 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 1.8 million. This is a good sign as it is always nice to have a liquid stock. Prices have been falling strongly lately, it is better to avoid new long positions here. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Valuing financial institutions. Understanding why financial institutions are different from traditional real sector companies is key. Banks function differently than traditional cash flow-driven companies. Traditional companies create products to make money. The products of banks are money. Banks are highly levered and they do not reinvest debt in the business and instead use it to create more money. They make money via interest. So, they view debt and interest differently. That's why, our favorite discounted cash flow valuation method doesn't work for banks and insurance companies. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average PE ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $239.05. When we apply the margin of safety to that value, the fair value of the stock would be $167.33. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Discover is 17.78. Minimum rate of return. I will use 12%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Discover, analysts forecast growth rate around 5% per year in next 5 years, and future PE around 8. I will use 3 different scenarios for Discover company: bad, average, and good. First scenario. Discover will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, -2%. Future PE would be low, 6. In this case, the fair value of the stock today would be $32. Second scenario. Discover will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 2%. Future PE would be average, 7. In this case, the fair value of the stock today would be $54. Third scenario. Discover will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 9. In this case, the fair value of the stock today would be $82. As you can see, Today the stock is overvalued, $104, even if we expect Discover's high performance in future. The revenue will grow only by 3 to 5% on average per year in the next 5 years, and prices have been falling strongly lately. It is better to wait for signs of reversal. And the stock looks overpriced. I may consider buying the stock when the stock drops below $80. Company's strengths. Discover Financial Services is a direct banking and payments network company. Discover pioneered cash rewards credit cards. The company also offers personal loans, student loans, online savings accounts, money market accounts, and CDs. The network business consists of the Discover Network, Pulse, one of the nation's leading ATM debit networks, and Diners Club International, a global payments network. The company gave robust guidance for high single-digit average loan growth in 2022. Discover will benefit from improving economic conditions and the roll-off of government stimulus measures. The company has been able to capitalize on the recovering economy with new account growth. In 2021, new accounts rose 23% from the prior year. International expansion remains a significant opportunity for Discover, as its domestic credit card portfolio still accounts for 80% of average earning assets. Discover's return on equity of 40% and profit margin of 45% are amongst the best returns of the industry. Discover has a return on assets of 5%. This is comparable to the industry average of 3.3%. Risks. Risks include an unexpected and greater than anticipated deterioration in credit quality, lower than anticipated consumer spending, particularly if consumer spending or credit erodes in the aftermath of the post-COVID-19 recovery bounce, a more competitive operating environment, and heightened regulatory scrutiny. Based on estimates for the next 5 years, Discover will show a small growth in earnings per share. The EPS will grow by 1% on average per year. The revenue is expected to grow only by 5% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.